Well, a lot of people talk about the balance sheet, and they'll say, "Oh, I understand the balance sheet, and everything on those. It's just a point in time." And then I ask a couple of questions, kind of like, "Yeah, do you really understand what it is?" So, welcome back to another episode of John the PM, where we believe that managing projects is not just a job, but a way of life. And like I just alluded to, we're going to talk a little bit about the balance sheet. I might slip into the cash flow statement on those areas. We'll just see where we kind of go. But on the balance sheet, it is a statement. It is at a point in time. It's a snapshot, of such. Some people may call it your personal net worth, financial statement. There's a lot of different terms for it. On a personal basis, on a business perspective, I would always manage to your balance sheet. Okay, essentially, your assets less your liabilities equals your equity. Equity is another word for net worth. How much are you worth? How much is the entity worth? At that point in time. Once you take into consideration all the assets minus what you owe, those are liabilities. So a couple of things that could happen. Sometimes I'll hear, "Oh, I got a $10 million, portfolio," and eventually, if I ask enough questions, I'll discover that they're, first off, they didn't lie. I'm not going to say they didn't lie, okay? But first off, yeah, they probably do have a $10 million portfolio. Awesome, congratulations, real easy to do, especially if you're carrying $11 million worth of debt. Okay, so 10 minus 11, that's -1. You're still behind the eight ball there. Say you got $1 million portfolio, but you got $900,000 worth of debt. Well, you're not worth $1 million. You're worth $100,000. It's an accounting function, in other words. Now, clearly, you want to manage towards equity. Okay, that's the assets minus your liabilities, but you also kind of want to keep them in balance. So in my on my personal side, I would rather have like zero liabilities and all assets. Why? One thing is that your stress level is just a lot lower. Now, having said that, if you're in a business concern, I can understand why you may want to, take out a loan. Just remember that if you take out a loan, it is a personal line guarantee, so it is against you. It's not against the corporation. Okay. Read the fine print so the business can go out of business, but you as an individual, you're still liable for those funds. So just kind of keep in mind before you sign on the dotted line. The other issue that sometimes I run into with liabilities, when they take out loans and things of that nature, they go out and they see a building. The building is worth 1.5 million, or it's on sale for 1.5 million, or they can get it for 1.5 million. Okay, they do an appraisal, or excuse me, they figured that with some improvements on it, they can get the building worth 2 million, and now it's worth half a million. Okay, so they bought the building for 1.5 million with some improvements. They got the valuation of the 2 million. 2 minus 1.5 is a half a million. Okay, so that's how I kind of got there. That could be a good thing. I'm not going to say it's not. But one of the problems is that if you run into an issue or concern or cash flow issue, you're not going to be able to just sell that building. Well, first off, you got to have a place for your business. That's probably the first issue. And then second, it's an illiquid asset, so you can't liquidate it quite as quickly. That's sometimes what we'll say you're house rich and cash poor. Same thing on a personal side. Say that you have a lot of acreage, land that your family owns. Congratulations, awesome. But it's not going to. It may sell quickly, but it's more likely it's not going to sell like quickly, as quickly as you like. Long story short, assets minus liabilities equals net worth. Hopefully, we've understood that. But you got to look at the types of assets you have. If you have all illiquid assets, meaning land holdings and things of that nature, you may not be able to get a lot of cash out of it very quickly. You can probably take a loan out of it, but then that causes problems on the liability side. Okay. Now you kind of move up your asset classes to something that's highly liquid, meaning cash in the bank. That can be a good thing. But again, I would throw in a caveat: is that cash actually working for you? So in between, you got between your cash and your land holdings, illiquid assets, you might have investments and things of that nature. And depending on the type of investment, it might take a minute or two to actually sell it and get it back. But it's faster than land. On those assets, keep in mind that the valuation can go up and down. can go up and down. Everybody knows about the stock market. It goes up and down. Well, land also goes up and down. You do have to keep a good understanding about, the valuation at various points in time and what your, positions are. Now, let's look at the other side, your liabilities. Again, you're going to have, current liabilities. These are things that are due in like 30, like immediately. So when you go to the grocery store and you pay for the food, you're paying immediately. Or if you use a credit card, it's due 30 days, something like that. You can also have long-term debt. Say that you went and bought a house or you bought that building. That's a long-term debt. Again, you want to kind of manage how those are all looking and shaping out. Now, if it was me personally, I would try to drive it down to zero. The reason why is because it just reduces your stress level, in and of itself. So that in a nutshell is kind of like your balance sheet, your net worth. I think that most people find it much more relatable when they look at it from their personal life and then expand it over to the business, small business on that side. Like I said, a big corporation order of magnitude is completely different. A couple of mistakes that people, I don't want to say usually, but commonly make is, let's say they go out and they get a home equity loan. Okay, let me back up. Let's say they have $100,000 worth of debt. Okay, awesome. Not really, but let's just work with $100,000 student loans and everything, not including their house. They want to go and get a home equity loan, a HELOC. Let's say it's $200,000. Okay, boy, they got some equity built up in that house. Okay, so they take $200,000, and they, in using air quotes, they pay off all of their consumer debt. Yes, they did pay off their consumer debt. I'm not going to say they didn't, but the problem is that they really just did a shell game. Okay, because the liability is still on their balance sheet. Okay, it's just in a different category, and some people don't recognize that. So it's something that you have to be cognizant of. Now, here's the other issue, especially in dealing small business or personal finance. That $100,000 that you had left over after paying all those debts. What a lot of people then do is they'll take that $100,000 and they'll buy a depreciating asset, like another car or something of that nature, go on vacation, eating out a lot, and you just burn through it. And so now they're actually worse off than what they could have been. Okay. Now, I'm not saying that's always the case. Okay. There are some people that are highly disciplined. Believe it or not, we're pretty highly disciplined in that. We have taken out loans to do certain things, but it was used specifically for that asset that we were buying, and we paid it off like almost immediately or as quickly as possible. Again, we just don't like that, and highly encourage people to kind of take the same attitude. Just makes life a lot easier. All right, hopefully that kind of helped you. If it did, hit that like button, hit the subscribe button. Helps us to be of service back to you. And in the meantime, may all of your projects be highly successful.